All right. So it looks like we got some more news that just came in. The White House decided to wake up today and say mortgage rates are, well, too high. So let's just buy 200 billion of mortgage bonds and see what happens. Because when markets are complicated, the solution is always throw money at it and hope vibes just improve overall. And guess what? Wall Street, they loved it. Mortgage stocks ripped, housing names exploded, and Twitter immediately declared the housing crisis solved. Except it's not. What's up, M Beach? Hold on, I'm about to give an update on mortgages because Trump just executed 200 billion in mortgages right now. So let me give you guys a rundown real quick. You missed SPY calls that went for 695s, 0.11 to 0.32 so far. They're probably even higher at this point. Aaron just basically made $7,000 on stream today. Anyways, this is not a solved housing crisis, and what just happened is way more interesting than the headline suggests, according to CNBC. Let's go ahead and break it down. So what actually just happened? Well, President Trump instructed representatives, and that wording matters, to purchase 200 billion of mortgage-backed securities. The translation: this is not a Fed rate cut, this is not quantitative easing, and this is not fiscal stimulus. This is targeted MBS buying, most likely via Fannie Mae, Freddie Mac, or FHFA directed activity. The goal is to push mortgage rates lower, make housing more affordable, and calm a politically sensitive market. Markets immediately front-ran the idea. Now, why did mortgage stocks go crazy, and which ones did today? Well, let's look at the scoreboard. Rocket Companies, RKT, hit new highs. UWM Holdings, UWMC, has massive volume behind it cooking. PennyMac, PFSI, has strong upside. And Open Door opened because, well, of course it did. It's Open Door, right? It's the AMC of the housing market. Now, why did this happen? Because lower mortgage rates don't magically fix affordability, but they explode transaction volume. And mortgage lenders don't care why people refinance. They just care that they do. This is a refi trade, not a home buyer trade. Now, this is not about home buyers, and that's one thing everybody needs to understand. Let's be honest for a second. If mortgage rates drop from 6.2% to 5.2%, that helps, but it doesn't fix home prices, inventory shortages, insurance costs, property taxes. But what it does fix: origination volume, refinance activity, and earnings visibility for lenders. This is stimulus for balance sheets, not families, and Wall Street knows it, okay? The market is pricing a shortcut right now, and this is the real story. Markets have been stuck in a bad narrative loop. Growth is slowing, inflation is sticky, and Fed cuts are delayed every time. So instead of waiting for a recession or a Fed pivot, the White House just went around the system. This is rate relief without rate cuts. Markets love shortcuts. They don't ask questions until later. Now, what is the bond market watching right now? This is where it gets a little bit dangerous. Bond traders are asking who's actually buying these MBS, how fast, and what happens when they stop. If MBS demand rises but Treasury supply stays heavy and inflation expectations don't fall, you actually end up with lower mortgage rates and higher Treasury yields. That's how distortions start. And distortions, well, they always end badly. So let's go ahead and talk about some outcomes. Scenario 1, we see a fast and clean execution, which would be our bullish signal. We see 200 billion deployed quickly, mortgage rates drift toward 5%, a refi boom, and mortgage stocks will keep running. The best case for equities, and it's neutral for bonds. Scenario 2, a slow, messy rollout. We see legal questions, agency confusion, and more political noise. The rates dip, which causes a stall. Stocks are going to fade, which causes a chop, and that volatility will remain elevated. Scenario 3, the bond market revolt. Treasuries go ahead and sell off. The yield curve steepens and finance conditions tighten elsewhere. Housing gets relief, but the rest of the market is going to pay for it. So now when we step back after these three scenarios and look at this at a 30,000 foot view to see things very clear, housing is politically untouchable. The rate's too high, well, we intervene. If stocks wobble, then that's just support. But the Fed, it's still stuck with inflation optics and credibility. So instead of cutting rates for everyone, they're easing selectively. And markets are trading the beneficiaries, not the mission statement. So no, this isn't a silver bullet. It's a sugar high. It's a refi trade. And it's another reminder that markets don't move on morality. They move on liquidity, incentives, and speed. And right now, Wall Street is saying, thanks for the shortcut. We'll worry about the consequences later. I'm Max Pitts. This is Trades and Gains. Like, subscribe, comment if you are planning on buying a house in 2026. I know I'm not, because I currently can't afford it. Anyways, hope you guys are having a great day so far. And I will talk to you all later and catch you in the next video.